I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hey, Jim.
I'm taking a look at the Trudeau tax promises. Nail the top 1% with higher taxes. Cut taxes for the so-called middle class, but that's only the top third of Canadian taxpayers. The bottom two-thirds, who make 25, or I should say 45,000 or less a year, will not get a tax break.
Well, they're the ones who pay the least tax as it is, right? So it's amazing how small a percentage of the population actually pays tax in the first place. Income tax we're talking about, Jim.
Yep.
People pay other kinds of tax, obviously consumption-based tax and things. But in terms of income tax, I think that the big problem for the Liberals is going to be that they came in on these budget assumptions, which had oil rebounding in 2016 and had a modest kind of recovery slated for Canada going over the next 12 months and thereafter. And I think that we've had some pretty significant downgrades to the outlook since they've even come to power, just even in that short a period of time. And that's going to dramatically impact the math. So the revenue side, I think, is going to come in light to what people have been working on in terms of assumptions. And so their ability to cut tax, I mean, obviously they want to lower tax if they're going to try and give more money in the pockets of consumers to help, which is such a huge part of our North American economy. But without the revenue, I think they're going to have to rethink the whole thing, and that's tricky. You saw the PBO this week, saying, "Hey, the global economy is a lot weaker than we thought," and that's sort of a common theme these days.
Yes, expect more and do more with less.
Well, yes, and that probably means, cuts in the government in general. Like we can't afford. I look at it this way: for 15 years, we had a massive global debt bubble, right? And we had it first in the technology space, in running into 98-2000. We had, record levered buyouts and record multiples on all sorts of financial assets on the whole, unrealistic expectation of perpetual blue skies thanks to the internet. And then you had the same thing that happened in the 07 to 08 period there with the, belief in housing always going up and people always being able to borrow and all that. And all that really led to asset bubbles. You had the QE bubble from 2009 through, let's say, even into 14 before that one sort of began to deflate. And in the process, you've had massive escalation in a few key areas that are benefiting off of, or that were tied to those rising asset values. So one of the things was executive compensation, which became heavily focused in assets or equities, stock options, that kind of thing. So that ballooned this massive overpayment to executives as that asset bubble went up with the credit bubble. At the same time, you had a massive insurgence into tax revenues, government revenues. And so governments, if you will, sort of became bubble in their formation as well. Too big, expecting too much perpetual revenue. So in this whole mean reversion process, which I submit to you, commodities have been leading the cycle since 2011 in the mean reversion, and continue to do so, oil and copper and whatnot, making, coming back to their all-time lows this cycle just in the next day or so. But all of that really means a downsizing in everyone's coffers. So government revenue that's tied to those asset bubbles has to come down, as does executive compensation, and wages have to somehow get a bump before we're going to be able to get more consumption back in the society. So it's going to be a time when everyone has to scale back expectations cash flow and be more efficient with it. And that goes for governments too.
Now, what about these plans to bring in robots to do everybody's jobs starting 5 years from now? How's that going to help the economy?
Well, here's a couple of things about that. One is that we do have something going for us in the sense of the boomers being that big massive population that have stayed in the workforce longer than they expected because their savings has been deficient and their spending has been so high. They're working well into their 70s. This idea of Freedom 55 is a very scarce concept today, right? Most people realize they have to work a lot longer. So you've got that big bulge of populace that is now working longer than anyone expected, and that's had a very negative effect on the workers behind them, right? Which are fewer in number, but who haven't been able to get a shot at some of the more plum spots in terms of the workforce. Now, one of the good things about as the boomers fall off, there are less people behind them, and so that means there should be wage pressure or power for those workers, they'll be in higher demand because they're a smaller amount of people. Now, the advent of more robotic help in various aspects of human life, clearly that's coming. Clearly we're going to have more robotic intervention all across a whole bunch of industries and services. So on the one hand, that will probably alleviate some of the wage pressure, some of the inflationary pressure we might otherwise have seen as the boomers fall off and the smaller cohort behind them take on the jobs. So I think there might have been more wage pressure, but there'll be less because of the robotics. Now, the other thing that's been hugely depressant of wages in the past number of years has been this globalization, right? China coming into the WTO in 2001 and the huge trade exodus that took place, multinationals doing manufacturing overseas, that was a huge negative for North American wages in the past 15 years for sure and longer. So I think we're in a mean reversion in that at the moment as well, Jim. We're seeing a lot more emphasis on local and reinvesting in your own community and cutting out sort of the middlemen and the costs of doing things in foreign countries. And the revelation is hit that, hey, we're losing the ability to spend in our own country because we're throwing the labor overseas. So I think in this new climate, the pendulum is swinging back. It's been for a long time, it's been in favor of corporate profits at all costs, literally at all costs, of the environment, of taxes that would have otherwise been collected, but they've had all these loopholes and tricks. All the stuff that has helped corporate profits be on an enormous upswing are now beginning to mean revert, and there's a kind of a general swing to almost socialism in the world, Jim, I'd submit to you, in various ways, and many people may see that as horrific, but I see in its most moderate form, I see it as a movement back towards investing in people. And that means, obviously, as I say, the robotic component will be one of the things that offsets some of the demands that labor is going to be able to make. But on the other hand, the population and moving jobs back from overseas to North America, for example, is likely to also help with that. So I think, generally speaking, we've been through a really rough patch for labor. I think that I'm more optimistic about that going forward. And as I say, as the boomers finally move into retirement as they move into their 70s.
Well, when you say a movement towards labor, apparently Lufthansa is really taking it on the chin with their pilot strike.
Oh, is that right? I haven't followed that story.
Oh, yeah. The CEO is under a lot of pressure to settle this thing.
Well, there's a lot of stories across the gamut, really. There was lots of talk about, more of the Republican debates, for example, in the U.S. There's another one the other night. A lot of negative sentiment to banks, lots of negative sentiment to large corporations being expressed, mostly mouthed by the politicians, but the fact that they're being as brazen as they are in some of their comments is not making the large corporations and finance masters very happy, because the public mood has swung from adoration and adulation of our corporate executives to one of frustration that they're being paid so much and everyone else is losing. And I think you're seeing that across all aspects. Interesting linkage, and I've mentioned it before, but a story today, linkage between finance and energy. Now, I've talked about this in Canada, how we have been dominantly, our finance markets have been dominated by energy and commodities companies and the finance arms, the Canadian banks and investment firms that bring them to market and help them raise funds. So they were on this, going back to this huge bubble phase that was on from 2000. That really meant a great inflation in the fees and profits of those institutions. So as energy did well, finance did well, right? But now, for example, today we got a story that Manulife Financial, of course, a major Canadian institution, posted a 43% decline in their third quarter profit. Why? Because they took a big hit on their oil and gas investments. So, as I said, it's not just energy companies that are hurting today. It's the finance companies that were servicing them. It's the legal firms that were servicing, the accounting firms that were, all these services that were linked into the sort of the flow that came from that sector. And I think we're going to see more of that. I think that the large corps are in for a tough slog here, and because they've managed things very poorly. This is classic behavior, right? When money was flowing and everyone thought that the good times would never end, they didn't save a lot of it, they spent a lot of it, right? They did dumb things, as we've discussed before, like buying back their own shares, like borrowing to buy back shares. And I put a piece on today that so eloquently points out the folly of that as a management practice. Are buybacks an oasis or a mirage? And I urge everyone to read that article. It's what I've been trying to articulate over the past couple of years at what a destructive strategy this is and how it's literally about executives cashing out, taking cash out of the system and leaving IOUs in the drawer for the shareholders, the company itself, the employees, everything. But while it's going on, it has this sort of a supportive effect to stock prices, so people don't pay attention or don't realize that it's extractive and destructive financially to their vested interests. They think, oh, look, management's magical, revenues are falling, but they're still manufacturing earnings and they're getting the stock price to go up, so we're happy. But they don't realize that when the stock prices begin to mean revert, the company is left emaciated because it has higher debt, has lower cash, and has a lot of, nonsense on its books, so to speak. So again, that's part of this whole deflation aspect where people start to understand that there's been a lot of extraction and not a lot of value added. And that's where we, I think, finally break faith with those antiquated concepts and move to a new, more practical strategy. We've seen it throughout history, and I think it's coming now, more of a what can we do to actually help build our economy. And that means, retrofitting and rejigging in the whole energy sector as a building block, for example.
If the government's going to encourage investment in energy, should it not be in oil, but in alternative energy like wind and solar and tidal power? Canada should be leading the world in tidal power. We have the world's longest coastline, yet I don't see any projects out there really taking advantage of it.
Yeah, it's interesting you mentioned that. Bill Nye was on Bloomberg just this, I think it was yesterday morning or the morning before, and he was pointing out that, we have enough wind power off the east coast of North America to basically, if we could harness it and get serious about it, to power the entire country, to power the entire electrical grid. And of course, then we can do electrical cars plugged into that. So there's lots of people that know that we can do things a whole lot smarter than we've been doing it. And I think that this political shakeup and aversion that's mounting to multinational corporations, I think that's part of the catalyst socially to get policies changed. You're seeing a lot of protests all over the world. I'm sure you've noticed that, Jim. In Europe, certainly, there's a whole bunch of pretty startling things going on. Governments falling, people saying they reject statistics published that otherwise they'd been wholeheartedly, accepting over the past couple of years, and now starting to scrutinize everything, not just in China where it's been just like brazenly false, the whole thing, the whole economy. And I think it's getting actually worse in China right now in terms of slow down, and it's harder for them to manufacture good news stories out of negative news everywhere they look. So anyway, it's all part of this cleansing process, and I think it was entirely foreseeable. And, I put on some charts that my partner Corey had done from 2011 a couple of days ago on the blog, just to show that, for anyone that wanted to see it, the oil collapse, the copper collapse, all that was baked in the reckless bets and leverage that were placed in the past 15 years. And when things were at a QE frenzied peak again in 2011, anyone with an objective eye would look at it and say, how is this possibly going to be sustained, and isn't long-term support more like 70% lower than where it is at the moment? And indeed, that's exactly what we're seeing. We're seeing that retrenchment. Oil's come off more than 63% since just June of 2014, and copper's down about 35% and falling. So it's all of this together, Jim. It's the China story, mean reverting. It's the commodities story that rose with it, mean reverting. It's finance and energy and all those leading sectors starting to, have to reprice for the new world where people are spending less and saving more, and we have a huge amount of supply. Have you noticed the story of the tankers that are sitting like 2 miles long in tankers waiting outside of Galveston, Texas, of oil from the Middle East? And the refineries are full, storage is full, tanks are full. There's just nowhere to put this stuff anymore.
Well, you'd never know it by the gasoline prices in Vancouver, where we're paying about $1.30 a liter right now.
There you go.
So we're still paying high prices for gasoline, even though the price of oil is low. Mm-hmm. And people are asking me why, and I said, because there's so few oil companies in Canada that sell gasoline to consumers. They have you over a barrel. It's not a monopoly, but pretty close.
Yeah, and the refineries are in the driver's seat, right? Because everyone's trying to pump crude into refineries, and the refineries are already at max capacity, so they can put a premium on the price and say, you guys all want us to work for you. Well, it's going to cost you, and that helps to keep the price of gas higher for consumers as well.
And they haven't built any new refineries for the past 30 years. There's a reason for that.
Right.
An excuse to charge you more. We'll have more with Danielle Park right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park. You say the CMHC's boss is even saying the real estate bubble is putting Canadian taxpayers at risk. How does that work?
Yeah, so same old playbook we've seen in other countries, and especially in the United States. Prior to this, Canada learned all the tricks from our neighbors to the south, and in the big boom in housing we've had, especially since the Great Recession, we've had this a massive push to get a bunch of mortgages originated by the big banks and mortgage brokers, but then as soon as they are, of course, the risk is downloaded to the Canadian taxpayer, a la the CMHC, who underwrites the massive majority of mortgages in Canada. So as they've, been in this hot contest to sign up borrowers and take out loans, they've been being paid up front. This is the most catastrophic business model for anybody that's holding the bag, right? The people who are all collecting their commissions up front are incented to put business through, but they're not left accountable for any of the losses if the debts can't be repaid. It's exactly what happened in the subprime mortgage space, the Fannie and Freddie debacle in the United States, and it is exactly what's facing Canadians today. Again, right at a time when, the irony is that people thought that was a sign of progress, right? That constantly rising home prices and bidding wars and all this appetite for housing when people could barely afford, to keep it heated once they had it. Everyone, including politicians, thought that was evidence of progress for Canada, but in fact it was, a step backwards in terms of, same deal as the stock buybacks. Certain number of people cashed out on the front end and everyone else was left holding the bag. So now you've got an exodus because there's, drying up of some of the Asian money that can come into the country, both because China's cracking down on money flows out and also because they've had so many implosions in the China housing and stock market itself that there's less cash to be flowed out. And at the end of these speculative phases, this always happens. And as the cash starts to recede, cash flowing into the country as well, our currency, you may have noticed, Jim, is fathoming back towards the cycle lows this week. And so foreign investors, it's one thing to say, great, the currency's dropped, I want to buy because it's more affordable. It's not so good once they've bought, right? To have their value of their, quote, investment falling with the currency does not make them happy. And so you tend to see people pulling back. And as you know, in areas like Vancouver where you live, the average person is not the driving force of the purchases in that area because it's long been priced way past their affordability metric. So this foreign capital was the force du jour that was driving all the price increases the past few years. And so once that foreign capital stops flowing, there's a scarcity of people who are able to actually purchase and service and pay taxes and heat, etc., on those extremely overvalued properties. So that's when the flows begin to revert. People start looking for, putting properties up for sale and finding that they aren't as liquid as they'd assumed. And that's typically, the CMHC CEO was just saying, if we had anything close to a U.S. style or, nothing like even some of the European experiences, for example, the south of Ireland where properties dropped 60% in the 2007-8 debacle. We had drops of 30 to 50%, even 60% in some of the hotter areas in the U.S. in that cycle as well. If Canada even had half of that, even a 30% downturn, even 25%, the losses in this highly levered mortgage market would be huge, and they would flow to CMHC to make them whole. The Canadian banks won't have a lot of that risk still on their books. We, the taxpayers, do. So it's not a happy state for us because, at a time when pensions are underfunded, savings is low, debt levels are high, and then taxpayers are going to have to, foot the bill for these debts that have been recklessly underwritten.
What can you do to protect yourself in a situation like that?
Well, as I've been telling people for the last several years, you need to run your own balance sheet in a respectful and intelligent way, which means lower your leverage. If you can't afford what you've currently got, but you're hoping it'll go up in price, so you're trying to grin and bear it, sell sooner than later. The demographic bubble that's coming here of people trying to get out of overvalued properties is stunning. I look at it every week and it just gets bigger. Anecdotally and actual factually, everything you look at, if your eyes are open, you'll see that there's a world of people that are overhoused and saying, I need to downsize. Even the ones who don't want to, aren't feeling financially crimped and saying, I need to get cash out of my house to live on. Even those people who aren't in that boat are saying, why do I need all this maintenance and insurance and upkeep? I'm wanting something less. And so that is the bulk of the people that own properties in Canada today. And so they are all starting to look for an exit. So, if you're in that boat, if you're one of the people that feels that you're overhoused or for whatever reasons you think you're going to want to get out of your current housing within the next couple or 3 years, I would suggest you start doing it sooner than later. For anyone that has a bunch of outstanding debt, if you have the opportunity to apply cash to pay down debt or, to extend yourself further, by all means, pay down the debt. For those that have a bunch of investments in these markets, people who are holding your traditional stock and bond portfolios, you need a very sober look at how your financial picture will be impacted if we have another 2008 style decline in asset prices. That does not, P.S., bounce back quickly this time because there won't be the QE face stuff anymore. You know, it's interesting, you see all the central bankers that spoke today in the U.S., Jim, and every single one of them came out and said something supportive of monetary policy, and every single speech the stock market dropped further. I think we're totally at the end of any sort of respect or credibility for central bankers at this point. They all take to the news and sort of jawbone and try and, keep the game going, but I think that people have lost faith. We see this in Japan, we see this in China, we see this in North America and Europe. People realize that these were empty promises now, and that, it's sort of we've been duped. And I think that everyone is starting to get this theme of how do I cash out, whether it's real estate, whether it's the stock market, whether corporate debt is really in a rough patch. The energy sector is not able to raise new capital here. This is the classic stuff of a downturn. When it first begins and prices drop, everyone's talking about buying opportunities. People are able to raise more capital in the debt and equity markets because investors, quote, investors think, oh, well, prices have come down 20%, it must be better now. But once they've come down 50 and 60%, it's funny, people don't respond the same way. They start saying, are you crazy? Why would I put any money in that space? And that's when the real liquidity crunch hits. So I think, going into this with your eyes wide open, as I've said, go back and look at the charts, go back and look at the blog. We've been talking about this. The writing's been on the wall, at least since 2011. And you don't have to just, go into the storm unprepared. You can do things that are proactive, and a lot of it has to do with self-control and being aware and making wise choices instead of, blind choices that bank on greed or luck.
Danielle, thank you very much for chatting with us.
Thank you, Jim. Good luck.
Everybody keep your fingers crossed and watch your accounts very carefully. My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.